Yo, my name is Sebastian Salvela. So I was planning on making a different video this week, but something happened on my last video. So right now I got around 67 subscribers, and at that size, it's probably just family members and friends. So I usually expect to see like a handful of likes, but this time I got a dislike. So I had to do like a double take just to make sure I was seeing it correctly. And then I saw a comment saying that the cap rate is not a rate of return, which is something I said on my last video. So I immediately grabbed my source to make sure I didn't make any mistakes. And there it was. Frank Gallinelli says the NOI is the return and the cap rate is the rate of that return. So I commented, the author that wrote this book said it was. And then he or she went on to explain their position and why they thought that maybe I took it out of context or that both the author and I were simply wrong. So after going back and forth in the comments, I must admit they made a lot of great points. So this video is going to be to clarify the cap rate so that you guys can really understand what it is and how you could use it in your investment decisions. The cap rate is used a lot in real estate, and it gives investors a snapshot of the yield of an asset for every dollar they invest. Okay, that probably sounded complicated, so let's break that down. So it's really easy to calculate. So the formula is NOI divided by the current market value of the asset. So the NOI is the net operating income, and that's the income that is left after paying all operating expenses. So you take all the income from rent, laundry units, storage, parking, and even vending machines, and you remove all the vacancies and all operating expenses like taxes, insurance, utilities, maintenance, property manager. So whatever is left, that's your NOI. So is the NOI the profits you make then? No. The NOI is only looking at operating expenses. So it's not looking at any debt service or any capital expenditure. So here when I say debt service, I mean if you borrowed money to buy the property, then you have to service that debt or pay it back. For example, for your mortgage that you're paying, that's you servicing your debt or paying the loan back. Capital expenditures involve all the money you spend to make improvements to the property or all the money you spend on big ticket items like replacing the roof or the furnace. So the debt service and the capital expenditures are not used in calculating the NOI. And these expenses eat into your profits and reduces your cash flow, which is how much money goes into your pockets. So the cash flow is your actual profit, not the NOI. So the cap rate is not a measure of expected profits. It's a measure of expected income from the assets, so not including debt and capital expenditures relative to the expected value of the asset. So with that in mind, when an investor is investing in a property, what they're paying for is not really the physical property per se. So what they're paying for is the income potential of that property. So they're paying now for all the money the property is going to make in the future. And then how much they pay today depends on how valuable they think those future streams of income are. Example, say you got the same exact cities generating the same NOI of $50,000 in two different cities. So in the first city, it's appreciating really fast and rents are going up every year. The second city doesn't appreciate as quickly and rents barely go up. So as an investor, you'd be willing to pay more for the property in the first city because those future streams of income look more valuable. Even though you paid more, you'd assume that that market is stronger and that the income potential is more attractive. So you might pay $700,000 for that $50,000 of NOI. So using the formula, that gives you a 7.1% cap. Now in that second city, because of how slow the growth potential seems, you might say that you don't want to pay anything more than $400,000 for that same $50,000 worth of NOI. A higher cap rate yields lower estimated value or less expensive, and a lower cap rate yields higher estimated value or more expensive. So when you pay less for a property at a high cap rate, you typically also borrow less money. And because of that, your mortgage or your debt payments are also smaller. So you would expect for more cash flow, but you should dig a little deeper because that's not always the case. The cap rate doesn't take into account all the money the property might be costing you or all the money it might make in the future. So you might decide to buy a cheaper property at a 12% cap on the south side of Chicago, but what you fail to realize is that maybe it's not a great neighborhood and it's hard to rent, or the tenants don't pay on time, or maybe it wasn't well taken care of and it has a lot of deferred maintenance. All those factors are going to affect your bottom line and affect how much money you can make. On the other hand, I could pay more for a property at a 5% cap on the north side of Chicago because it's in a desirable neighborhood. So it's always rented, so it's never vacant, and the rents are going up. And then the furnace or the roof or anything like that is fairly new, so my capital expenditure costs are low. So the cap rate looks at the NOI and the perceived value of the property at a certain moment in time. So it doesn't give you the full picture. So how do you use the cap rate then? So you use it to value potential properties and to compare what other investors are paying for similar properties in a similar area. So it helps you understand if you're paying too much. For example, say I'm looking at a potential property with an NOI of $20,000 and the seller is asking for $200,000. Now using the cap rate formula, that gives it a 10% cap. Now does that 10% cap tells me that the $200,000 is a good price to pay for that $20,000 of NOI? I don't know. I need more information. So I need to know what the market value is or what other similar properties recently sold for. So in other words, I need to know what other investors are paying for in this market. I could go to a real estate broker that knows the area well, so they could give me comparable sales or comps. So they tell me that properties that are similar to mine, so same number of bedrooms, same number of bathrooms, similar size and amenities, same school district, so they're all selling at a 12% cap on average. Now, because these properties are similar to mine, I could assume that their income and operating expenses are also similar to mine. So then I could use that $20,000 of NOI and that 12% cap to calculate their value. Doing simple math, that means that they're valued at around $166,666. So if I paid the asking price of $200,000, then I would be overpaying by $33,333. That would not be a good deal. And also overpaying reduces my return on investment. You can also use the cap rate to figure out by how much the value of a property would increase if you're able to increase its net operating income. Now, to increase the NOI, you could either increase the income or decrease the operating expenses. Now, say a commercial apartment building is selling at a 4% cap with a $50,000 NOI. So that puts its value at $1.25 million. Now, it might seem expensive at first, but then you realize that the property is 60% occupied. And then you find out that the tenants are not being billed for their own water usage. So you decide to buy the property because you know you can add value. So you renovate all the units and get the building to 90% occupancy. You also add meters to every unit so that the tenants can be billed for their own water usage. So you're able to increase the income and decrease the expenses. So say that you increase the NOI from $50,000 to $70,000. So using that same 4% cap rate, the new value of the building is now $1.75 million. So by increasing its NOI by $20,000, you're able to increase its value by $500,000. And that's one of the reasons why a lot of investors like commercial properties. So you could drastically increase their values if you can find ways to increase their NOI. So going back to what I said in my last video, I guess that saying that the cap rate is the rate of return makes it seem like a property with a higher cap rate makes more money, so it's more valuable. And we know from using the formula that the higher the cap rate, the less you're paying. I mean, either way, you should understand that when you're using the cap rate and you're using the current NOI, you're looking at its value at a single point in time. The cap rate doesn't tell you how much money you're going to make in the future and is not a measure of profits. It's a metric that helps you understand values and what the market is doing, so what other investors are paying for. That's all I got for today. If you think this video was helpful, make sure you like and subscribe and leave a comment to let me know what you think. I mean, I'm no expert and I'm learning as I go, and the learning should continue down in the comments. So let me know if you agree or you disagree, and make sure you let me know why. So thank you guys so much for watching, and I'll see you next time. Peace.